In this video, I will talk about how you can choose stocks that most likely won't go down. My goal is to help you decide which stocks are better to invest your money in. Keep in mind that nobody knows the future, so you cannot be 100% sure about any investment. But following a few basic advices, you will minimize your chance of putting your money in a stock that will go down. But it's important to know that we are not talking about the short-term movement of the stock prices. Over the short term, any stock can go down. No matter how good of an investor you are, no matter what stock you pick, stocks have volatility. They move up and down over the short term, even if it's the best investment in the world. Warren Buffett said that Apple is the best company on the planet. And yet, last year, if you bought Apple on the 14th of February, 1 month later, the stock price was down 30%. But if you choose the right company, short-term drops are not important. In fact, short-term drops are great opportunities. If you bought Apple on that date, on the 14th of February, today you would have a 56% capital gain on it, not including dividends. But if you weren't afraid to buy more shares when Apple dropped 30%, if you had bought Apple on March 20, today you would have a 121% capital gain on that second purchase. So we are not trying to predict the short-term movement of stocks, and sometimes even the best investments can drop in price. And sometimes there's no reason for the drop. So when a stock drops in price, ask yourself the question, is it because the fundamentals are weaker, or is it only the sentiment of the investors? Apple didn't have anything wrong with the fundamentals last year. People were only selling the stock because they panicked. Now let's see what are some of the metrics we can check before buying any stock to make sure they won't go down over the long term. There's a certain group of stocks that we call dividend growth stocks. These are companies that raise their dividend payments for 10, 15 years or even decades. We can recognize a dividend growth stock by looking at the dividend history of the company. And the dividend history should look like this. We can see that this company has been raising the dividend payments for long decades, even in recessions. And this might seem like an insignificant thing, but it's not. Dividend growth companies tend to outperform the market. And there's a reason for that. Those companies know that investors have the expectation of a growing dividend payment. Therefore, the management in these companies makes smarter choices about how they allocate capital. It doesn't mean that dividend growth companies will never cut the dividends, but it's highly unlikely. But of course, the dividend history alone is not enough to be sure that the stock is a good investment. Because the growing dividend is only a sign that the company is doing great, but it doesn't tell us much about the fundamentals. For example, we were looking at the dividend history of Coca-Cola, but I wouldn't invest in it right now because Coca-Cola has a declining revenue for the past 10 years. So this is why it's important to check the revenue growth of any stock, not only for dividend stocks, but any stock. Because of course, this is what investing is about. We buy a company today, but we want that company to grow over time. We want the company to generate more money over time, so it will be worth more in the future. And of course, if the company will generate 10 times more money in the future, the stock will be obviously worth 10 times more. There are many free websites that show us the revenue of any publicly traded company. For example, you can just go to Yahoo Finance and search for the stock you are looking for. On the balance sheet, the revenue is usually the top line. Now, the stock market is not always efficient. Stocks can be overvalued, fairly valued, or undervalued. So no matter how great the investment is, if you buy the stock when it's overvalued, you have a high chance of losing money. Because stock prices over the long term tend to return to their fair value. This is why it's important to buy stocks when they are undervalued. And this gives us a margin of safety. When we buy stocks with a margin of safety, we minimize the risk of losing money even if something goes wrong with the company. There are many things we can check to determine if a stock is undervalued, but generally, the dividend yield and the PE ratio can give us some clue about the valuation. A higher dividend yield and a lower PE ratio can mean that the stock is undervalued. A very low dividend yield and a high PE ratio can mean that the stock is overvalued. However, a very high dividend yield doesn't necessarily mean that we should invest in that stock. In fact, a higher dividend yield usually means a higher risk. The dividend yield is high when most investors stay away from that stock. So when you see a stock with a high dividend yield, always ask the question, why is it that investors not buying this stock? And it's not because nobody else knows about it. So all in all, you can highly reduce your chances of losing money if you buy dividend growth stocks that have a growing revenue and you buy them when they are undervalued.